Greetings from all of us at 5-Star Metals. My name is Ty Chapman. I'm the president of 5-Star, and welcome to our January 2019 market outlook. Of all the things I read this month, the most interesting and I think important news over the long term is that the EIA in their annual energy outlook predicts now that the United States will become a net energy exporter by 2020. So I'm starting you guys with a chart that kind of shows where we've been the last few years, but I want to note we haven't been a net energy exporter since 1953. So that's a dramatic change. It's a change that, while predicted to happen, wasn't predicted to happen this quickly. So I'm excited about that. And in the next chart, I'll kind of show you the breakdown of what that's going to be. The good news for all of us in our industry is that it's projected to be liquefied petroleum products. So the growth's not really coming from coal or other things. It's coming from a source that we care about and that will ultimately, I think, benefit our business. But with that, and we're going to discuss this in detail in the Light Sweet article entitled America's Light Sweet Problem. I hope you guys read that because it's an interesting dilemma. As many of you know, over half of the rigs operating in the United States are operating the Permian and in shale plays, which produces primarily light sweet crude. And that's great because light sweet is easier to refine and produces more of the refined products that we ultimately want, but you still have to have heavy sour. And so over time, as you can see from the graph I'm showing you below, we've increased our production more and more of light sweet while diminishing our production of heavy crude. And many of the Gulf Coast refineries, while set up to handle that, aren't set up to handle just light sweet. They have to have some blend of heavy crude. So we have to find a way to export all of that light sweet crude because it is valuable around the world. And right now, as I bemoaned in last month when I talked to y'all, we don't have enough pipeline capacity. And that's creating a huge problem in the Permian, but it also has implications over the long term. Luckily, some of that pipeline capacity should be resolved at the end of the year. But then the question is, how do we get that light sweet crude and how do we get it exported? Because one thing I did not know until this month is that the United States only has one port, and it's not even on shore, capable of loading a supertanker. Or fully loading a supertanker, I should say. So there are some projects that are on the horizon potentially, particularly a couple in Corpus Christi that are of real interest. But I encourage you to look at that article and read that article and understand the issue because I think it's got long-term implications. The other thing of interest on the light sweet front is that because we need heavy sour crude and because we just imposed sanctions against Venezuela, I have a real concern about our refining capabilities and where that heavy sour is going to come from. Again, we discussed that in the article about America's Light Sweet Problem, but suffice it to say, we're going to have to get that crude from somewhere. Mexico doesn't seem to have the capacity right now. Canada has a pipeline problem, so they're shut in. And Saudi Arabia, who could give it to us, probably isn't in a real hurry to do that because they just cut production. So it creates an interesting dilemma. And I've actually kind of showing you now some graphs, and they don't perfectly line up. But my point here is of total crude imports, which have somewhat decreased over time, increased over time, the percentage of heavy crude has increased. So we're getting more and more of our heavy crude from other places. So the next thing that I want to talk about is in December, I was kind of bemoaning the supply side. I spent a lot of time discussing that. And as you guys know, OPEC agreed to 1.2 million barrels a day. Well, I say OPEC, OPEC plus Russia, right? And we discussed that this month in the OPEC cuts, are they enough? And I'm going to briefly answer that question. The answer is we don't know. And we don't know for a number of reasons, but the EIA issued a new outlook in January in their short-term energy outlook, and they still show markets out of balance. I'm showing you that in the graph below. They show slight inventory builds, and that seems to comport with what we're seeing. So what you're looking at now is the futures curve. And you may remember from prior articles, last time we consistently did the newsletter, that basically backwardation is good, contango is bad. Contango means we think we're oversupplied, backwardation means we're undersupplied. And since the OPEC reached the agreement, markets seem to have reacted to move us further out of contango. We're about $1.77 roughly, and now we're about 35-cent contango roughly. And so the money's coming in on the market still being oversupplied, but barely oversupplied. But what I think is partially driving that and where we go this month in our total economic outlook is I'm concerned. And I'm concerned because of the demand side of the equation now. So I encourage you to read that article because I try and present the warning signs. The world is definitely slowing down. I should say the world economy is definitely slowing down. There's no doubt about that. The question is it going to affect the United States and by how much? We see economic contraction in the Eurozone. Italy is now formally into recession after 2 periods of contraction. Germany is slowing down to have almost no growth. And the United States is kind of all over the board. We see good news in that we see unemployment incredibly low, but we see the GDP, which flirted with 3% growth, which is amazing, now slowing down with an estimated 2.5, 2.6% growth. That's still good growth, don't get me wrong, but we're starting to see other warning signs. I discussed those pretty thoroughly, and I would encourage you to read that. Right now, I'm showing you the graph of the Purchasing Managers Index, and I'm mainly doing that because that is kind of a bellwether, and we can talk about consumer confidence and things like that, and those are great, and those are important metrics, but what people that buy things are doing, particularly industrial goods, is really important for our economy. So again, I would encourage you to read that article this month to get more information because my concern now rests more on the demand side of the equation. Simply put, OPEC cut 1.2 million barrels, but is that enough? I don't know. It would probably be enough if demand growth continued, but a slowing economy means slowing demand growth. So take a look at that. And the next article that I think that you guys will find interested is we focus more on the outlook for the oilfield services sector. You guys may remember that last month I projected relatively flat 2019 to a slightly negative 2019, and I still hold that projection. We deal with it fairly thoroughly in the article, so I'd encourage you to read it. But to kind of highlight, E&P budgets are all over the place. Most of your smaller operators seem to be cutting them, but most of your larger operators seem to be increasing them. So that sort of tells me that big oil is willing to gamble. If you don't have a lot to gamble, you're probably not gambling as much. Makes sense. Big oil can survive if they take a loss, smaller oil can't, so they're being relatively conservative. I'm showing you a graph now of one of the estimates from one of the think tanks. It shows generally slight upward trend for 2019 with an overall upward trend of around 6%. That may be true. Again, it's one think tank's opinion. There are a lot of them out there, but overall, we're getting mixed results. The Fed survey has overall indicated that we should expect a slowdown. We're seeing some backing down the rig count. We're seeing some oil companies announce lower E&P budgets, but we're seeing other companies increase their E&P budgets, and we're seeing other surveys that would indicate that E&P budgets are going to be increased. And so I maintain my guidance. I firmly believe that we need to be cautious and conservative, but that if anything, we'll probably see relatively flat and or modest increase or decrease for 2019 over 2018. So that kind of gives you my summary. I discuss all of this more in Ty's Take this month. I encourage you to read that and email me your comments. I would also ask each of you to please subscribe to our YouTube channel. I'm putting up a link on your screen right now. Please hit the button because I'd like to start sending out more of these, but I don't want to do it to our mass email list. So I'm hoping that I can get a subsect of you guys that are interested in getting more than once a month so that I can start sending these more because A, I enjoy doing them, B, I'd like to give you the information in more real time, and C, it's really hard to cover all of this information in a single newsletter every month. So as always, on behalf of myself and my coworkers, thank you for your friendship. Thank you for your business. We look forward to continuing to service you in 2019. If there's anything we can do, please let us know. God bless you and your family. Thank you.